Amazon is notorious for its ambition to implicate itself in every facet of consumers' lives, and as a result has grown to enmesh itself in virtually every market within our economy, all the while taking the market value they've extracted from the corpses of companies they've turned obsolete and added to the trophy collection that makes up the company's $1.4 trillion market capitalization. Describing Amazon as the apex predator within the jungle that makes up our economic system is undoubtedly an appropriate description of the company and its ability to strike fear into the heart of established companies lower down on the economic food chain. For many traditional firms, the prospect of Amazon entering their own market implies unparalleled levels of competition and an insatiable drive for market share, fueled by an investor base perfectly willing to finance unprofitable business activities. In many cases, the simple announcement of the company's entrance into a new industry vertical is enough to instill complete fear into corporate executives and their shareholders. Back in 2017, when Amazon announced its acquisition of organic grocery store Whole Foods for $13.4 billion, signaling its entrance into the grocery industry, the news tanked stock prices of many established grocery store retailers like Kroger, Target, Walmart, Costco, and Sprouts Farmers Market. All told, the announcement single-handedly wiped out a combined $22 billion in market value from the 5 retailers. And that was before Amazon had even begun integrating its newly acquired Whole Foods business into its Amazon brand and sold a single grocery item to any of its customers. But more recently, Amazon has taken on what was undoubtedly its most ambitious project yet, its foray into the trillion-dollar healthcare industry. Over the years, the US healthcare market has grown to become a $4.3 trillion industry and is expected to grow to $6.7 trillion by 2030. The true extent of the economic activity originating from this sector of our economy is hard to overstate. In aggregate, this one industry accounts for nearly 19% of the country's total GDP. And Amazon has long played with the idea of entering this giant market. All the way back in 1999, Amazon acquired a 40% stake in Drugstore.com, one of the first online pharmacies which allowed patients to fill prescriptions online and later receive them through mail order. And although the company was later sold to Walgreens for $429 million in 2011, Amazon continued to dabble in the industry, setting up a secret health technology lab called 1492, which explored different ways the companies could expand into the healthcare industry. Fast forward nearly a decade, and it's clear that Amazon's interest in healthcare should no longer be considered a simple side hobby. Instead, Amazon has moved beyond simply experimenting with the idea and has begun slowly allocating significant resources to its healthcare ambitions, leading to a string of high-profile moves like its billion-dollar acquisition of online pharmacy PillPack back in June of 2018, and more recently its $3.9 billion acquisition of One Medical and its chain of primary care clinics in July of 2022. However, the healthcare industry is notoriously a giant graveyard, filled with ambitious ventures by Silicon Valley tech giants to reinvent the healthcare industry. Despite attempts from many tech giants, including Google, Microsoft, Apple, and Facebook, the tech industry has failed to bring about any meaningful disruption to the industry to date. But in spite of this growing evidence against Silicon Valley's ability to disrupt healthcare, Amazon remains obsessed, some would say irrationally obsessed, with entering this industry. In this episode, we'll take a look at the motivations behind Amazon's obsession with healthcare, what their strategy for entering the market is, and what their prospects of success are looking like. Let's start with the reason why Amazon wants to expand into new markets in general, let alone into healthcare specifically. After all, Amazon has already expanded into numerous adjacent industries, leading to well-known offshoots like Amazon Web Services and Amazon Logistics. But the company has also expanded into more far-flung industries like financial services, entertainment, and even hardware, industries which have far less overlap with Amazon's primary business in e-commerce. And despite its success in entering and capturing market share from established players, oftentimes Amazon still remains only a minor player in many of these markets. Take online payments, for instance, in which Amazon Payments only accounts for around 8% of all payments made online. Or in the market for smart home devices, Amazon only holds around 19% market share. Even in the grocery industry, Amazon and its acquisition of Whole Foods have only managed to capture a meager 2.4% market share. So it's not unreasonable to wonder why Amazon is choosing to yet again enter a new market, instead of focusing on capturing more market share in those they currently already have a presence in. From an efficiency perspective, this would likely be a far more efficient use of the company's resources, since they've already hired the necessary expertise and built the infrastructure that brought their efforts this far. Entering an entirely new market, on the other hand, would require starting from scratch and would likely take more time, more financial resources, and more human capital. So at face value, it's not entirely clear why Amazon doesn't just maintain their current market presence. However, the truth is, they simply can't. Not because they wouldn't be able to, but because those markets wouldn't be enough. To illustrate this point, let's take a look at Amazon's price to earnings ratio. A company's price to earnings ratio, or PE ratio for short, is a financial metric that signifies how much investors think a business is worth relative to the cash that same business generates. Companies that have a low PE ratio signify that investors believe the company has already reached its earnings potential and that earnings won't increase in the future, while companies with a high PE ratio suggest that investors believe the company's best days are still ahead and that future earnings will be much higher than they currently are. And Amazon's PE ratio is staggeringly high, currently sitting at around 128. To put this into perspective, this pales in comparison to the average PE ratio of companies within the S&P 500 and far exceeds many firms that are competitors to Amazon, like Alibaba, Walmart, Microsoft, Target, and Netflix, most of which are considered high-growth companies in their own right. In other words, investors believe that the future earnings of Amazon will far exceed what they currently are, and therefore expect significant growth from Amazon as a business, even greater growth than any of its competitors that are fast-growing businesses themselves. And this unparalleled level of optimism for the company's future is very much by design. Ever since the early days at Amazon, when Jeff Bezos still ran the company, Bezos conditioned investors to cast aside conventional notions of profitability, and instead told investors that the business should prioritize capturing market share over all else in the short run, in hopes of capturing greater profits in the long run, essentially turbocharging the idea of blitzscaling that has become so ingrained in modern-day Silicon Valley. In a 1997 letter to shareholders, Bezos wrote, "We believe that a fundamental measure of our success will be the shareholder value we create over the long term. This value will be a direct result of our ability to extend and solidify our current market leadership position." Later going on to say, "Because of our emphasis on the long term, we may make decisions and weigh trade-offs differently than some companies. At this stage, we choose to prioritize growth because we believe that scale is central to achieving the potential of our business model." In other words, Bezos wanted to be very upfront in saying that investors shouldn't expect Amazon to turn a profit for the foreseeable future, and that investors should only come along for the ride if they were comfortable with such an unusually long investment time horizon. And as a result, Amazon developed an investor base that was totally on board with the prospects of operating unprofitably for years, something highly unusual in the modern financial era, where most companies' management teams live and die on quarterly financial results and are grilled by investment analysts for every possible risk facing their profit margins. And this distinction was a primary reason behind Amazon's ability to steal market share from those same established companies. Because after all, what's more terrifying to an old-fashioned company that has to deliver consistent profits and a nice quarterly dividends to its shareholders than the prospect of having to compete with a company that doesn't prioritize profitability and can instead operate at near 0% margins? But Amazon's high growth strategy is undoubtedly a double-edged sword, because even though investors provide Amazon a lot of leeway when it comes to operating unprofitably for years, their expectations for the company's growth are incredibly high in return. And while it might be feasible to deliver quarterly revenue growth consistently coming in above 30% as Amazon did between 2010 and 2012, doing so forever isn't realistic, which Amazon has definitely come to realize as the consistency of these blockbuster growth rates started slowing after 2012. And this makes sense because no company can keep growing its revenue at 30% forever, because the revenue required keeps getting bigger and therefore more challenging to deliver. But despite this fundamental truth about compounding growth, Amazon and its ever-growing stock price has to continue delivering high growth if it wants to appease investors' expectations. Current consensus estimates suggest that investors are expecting Amazon's yearly revenue to reach $821 billion by 2025. Up nearly 75% from the $469 billion in revenue the company earned in 2021. In other words, if Amazon wants to simply keep up with the market's expectations of the company's growth, it needs to figure out a way to add nearly $350 billion in top-line revenue. Failure to do so would undoubtedly cause the share price to fall significantly, something Amazon's management team desperately wants to avoid. But the reality is that finding a market that could add $350 billion in top-line revenue isn't too easy, and most certainly wouldn't include any of the markets Amazon is currently in. Take the market for smart home devices. Amazon's products like its Alexa speaker and Ring product line currently hold a 19% share in the market. But at a market value of only $100 billion, even if the company were able to triple its market share, it would only add a meager $38 billion to Amazon's top line. And the same can even be said for Amazon's bigger revenue streams like AWS, which currently holds around 34% market share in the cloud computing industry. Because based on the market's valuation of nearly $200 billion, increasing Amazon's market share to 50% would only add an incremental $32 billion, which once again wouldn't translate to a significant enough boost in annual revenue. So at the end of the day, the real reason why Amazon is looking to expand into new markets is simply because it has no other choice. None of Amazon's current business ventures provide a realistic path to adding that $350 billion in annual revenue the company needs if it wants to satisfy its investors' growth expectations. So the next logical question is, which industry should Amazon enter? Which industry is big enough to satiate Amazon's hunger for growth? Specifically $350 billion in annual revenue levels of hunger. Well, this is where Amazon hits a bit of a roadblock, because there aren't too many industries out there that offer this type of market value. If we take a look at the biggest industries based on yearly revenue, there's actually only 18 markets that are valued at over $500 billion, 6 of which Amazon already has a presence in, and 3 of which are just unrealistic for Amazon to enter. Curiously enough, however, healthcare-related markets account for 4 out of the 9 remaining options, and when combined with other healthcare-related markets not included in this list, equate to a total market value of $4.3 trillion, making it a pretty attractive target for Amazon. But market size alone isn't enough to justify Amazon's entrance into a new market. Instead, what really matters is how much of that market value Amazon can reasonably expect to capture. And much of that comes down to what opportunities there are to improve or add value to the current market, and iterating on any inefficiencies. And unfortunately, the healthcare industry checks pretty much all of those boxes. For one, healthcare costs have soared, far outpacing other goods and services whose price has increased dramatically in their own right, like the cost of housing and college tuition. In fact, no other developed nation has experienced cost increases for healthcare services similar to those seen in the US. Despite this, nearly every developed country has better health outcomes, with the US registering the lowest life expectancy amongst its citizens despite having the highest healthcare expenditure per capita. In other words, the US healthcare system spends more than other countries, but still delivers poorer results. And all this inefficiency translates to a less than ideal experience for patients, who have to jump through a series of hoops just to get their basic medical needs met. For patients who wish to schedule a first-time appointment with a primary care physician for something routine like blood work or a simple checkup, patients have to wait an average of 24 days before an appointment is available. Even for more urgent situations, hospital emergency departments across the US have an average wait time of 90 minutes before patients are admitted to the hospital. And that's before they're even seen by a doctor. The average patient with a broken bone waits an extra 54 minutes before receiving any type of pain medication. If you think about it, healthcare is one of the few industries where customers aren't really seen as customers. Outside the healthcare industry, businesses view their users as customers, who they stand to lose to their competition if the customer is left unsatisfied, leading businesses to prioritize customer service pretty heavily. But the same can't be said in healthcare. Instead, as patients, we've simply become accustomed to the fact that dealing with any medical services will just be a painful and annoying experience. As a result, the healthcare industry has become one of the most poorly regarded industries, with the pharmaceutical and medical care industry ranked as the first and third most hated industry by consumers. But the sad part is that doctors don't deserve the blame for this poor patient experience, because the service they provide is simply a product of the archaic infrastructure of the US healthcare system. The unfortunate fact is that the way the current system is set up forces many doctors and practitioners to spend the majority of their time dealing with administrative and bureaucratic nonsense, with the average physician spending just 27% of their working day actually performing medical services with their patients. Much of the remaining time is instead spent at a desk, dealing with administrative tasks, with doctors spending on average 49% of their working day completing mundane tasks like documentation, order entry, billing, and inbox management. In aggregate, administrative complexity is estimated to cost the US healthcare system a staggering $265 billion every year. So suffice it to say that the healthcare industry is ripe for disruption, making it pretty much Amazon's best bet if it hopes to meet investors' expectations of adding $350 billion in annual revenue to its business. The only question that remains is, how exactly will Amazon enter this market? What strategy will they use in approaching this trillion-dollar industry? Well, this is where things get interesting, because Amazon's strategy to enter the healthcare industry is truly a fascinating exhibition of strategic business thinking. Because Amazon's approach to entering the healthcare industry mimics that of the company's previous expansions, which have been guided by the idea of turning cost centers into revenue opportunities. The best example of this is AWS, the company's cloud computing division. Back in the 2000s, Amazon was still very much in its infancy, and was just beginning to expand beyond its core competency as an e-commerce retailer. But the company was having significant trouble with scaling its operations, because it was running an off-the-shelf infrastructure system that was struggling to keep up to speed with the company's growth. So after failing to find an alternative system on the market, a group of developers at Amazon proposed building a solution in-house that would power all of Amazon's growing businesses, leading to the launch of AWS in 2006, which eventually led to a 507% increase in software development productivity and a 72% reduction in downtime. And although the solution was originally intended to be used exclusively in-house, they figured other large corporations would have similar needs, so they began offering their services to outside customers, going on to sign some major enterprise customers, like Netflix, Adobe, IBM, Samsung, and Dropbox, which ultimately transformed AWS from a simple cost-saving exercise to a major source of revenue for Amazon, as the division grew from $700 million in annual revenue in 2011 to $62 billion by 2021. And it seems like Amazon has taken a similar approach to many of its major costs over the years. In fact, if we take a look at the company's primary expenses from more than a decade ago, it managed to take nearly every major expense and monetize it by creating a product around it which it can generate revenue from. Besides reducing technology costs by launching AWS, Amazon monetizes high product costs by developing product lines in-house like Amazon Kindle, Amazon Basics, and many more. In addition, high shipping and fulfillment costs led to the development of Fulfillment by Amazon and Amazon Logistics, while marketing costs were monetized by launching Amazon Marketing and its affiliate marketing program. And finally, payment processing was monetized by launching Amazon Payments. And it seems like Amazon's entrance into the healthcare industry will follow a similar playbook, specifically by targeting the company's own employee healthcare costs. Like many companies, Amazon offers comprehensive health insurance to its employees, which means that if employees experience any medical issues and need attention from a physician, insurance paid by Amazon will cover most, if not all, of the medical bills. But employee insurance plans can be expensive, particularly for Amazon, which is the country's second largest employer with 1.6 million employees, because at an average insurance cost per employee of around $16,000, Amazon pays an estimated $35.6 billion to insure its employees annually. And those costs don't even factor in employee paid sick days, or non-monetary costs associated with temporarily lowering productivity due to health issues that Amazon has to bear indirectly. So following its playbook of turning costs into revenue opportunities, Amazon launched Amazon Care in 2019. The idea behind the service was similar to most telehealth platforms, but catered specifically to Amazon's employees, who could access on-demand healthcare for any health concerns by connecting with a qualified medical practitioner through the Amazon Care app. The user could then explain over video or live chat whatever ailments they had to their doctor, who could provide guidance, prescribe any needed medication, or even dispatch a doctor to the patient's home for an in-person follow-up. And as the service received lots of positive reviews from users, Amazon switched from offering the service as a simple cost-saving endeavor towards productizing the platform by offering it as a service to other large employers, signing Hilton and its 141,000 employees as its first client in late 2021. But on the surface, Amazon Care isn't really a groundbreaking product in any way. The virtual care model has been well proven by now, and there's lots of competitors in the market, with companies like Teladoc, Doximity, and Amwell offering very similar virtual care services. But Amazon's rendition of the service has a unique competitive advantage over these other players, based on something called aggregation theory. The basic idea behind aggregation theory is that the internet fundamentally reinvented the way that products get distributed from their original producer to their ultimate consumers. Traditionally, product distribution was controlled by the manufacturer. Think Ford dealerships or Apple stores. But this all changed when the internet came around, because the internet led rise to a host of intermediaries, like Uber, Airbnb, Netflix, and of course Amazon, which created value by aggregating a large group of customers. So now instead of having a more direct relationship with their customers, producers have to fight with one another to get access to customers through these intermediaries, like many companies do to get on the front page of Amazon's website. This of course means that companies can generate significant value by aggregating a large base of users and then charging producers in the form of rebates or lower prices to access their base of users. And virtual healthcare offers a similar opportunity, because aggregating a large base of patients allows Amazon to control the relationship with consumers and commoditize the relationship with suppliers of medical services. But Amazon's competitive advantage here over the many other providers of virtual care is that it already aggregated a large consumer base with its 160 million Amazon Prime members, giving the company far more leverage when it comes to pricing negotiations with any supplier of medical services that they might want to offer to their customers. But before Amazon is ready to unleash its healthcare services to its 160 million Prime members and attract more enterprise clients, it needs to rapidly scale up its healthcare infrastructure to support more patients. both from a virtual telehealth perspective, but more importantly from an in-person perspective, because after all, providing medical assistance is still very much an in-person job. However, the proof of concept that was the initial Amazon Care pilot wasn't ready to support this grand vision. So instead of continuing to pursue organic growth, Amazon went the inorganic route by acquiring One Medical for $3.9 billion in July of 2022, and ultimately shut down Amazon Care a few weeks later. The acquisition of One Medical gave Amazon instant access to what Amazon Care would have been had Amazon continued developing it internally, providing Amazon with all the features offered by Amazon Care like its app, but more importantly, access to the company's network of doctors and its 162 clinics spread across 25 cities in the US. And the cherry on top is that Amazon gets access to One Medical's pre-existing enterprise clients, which includes companies like Google, Airbnb, Yelp, and Lyft, and in total serves 736,000 members, further expanding its base of aggregated users. But another benefit of expanding into in-person care is that it strengthens the healthcare ecosystem Amazon has been slowly building up. Because besides its primary care initiative with Amazon Care and now One Medical, Amazon has already been quietly working on a number of other healthcare offerings for years now. One example is a pharmaceutical offering with Amazon Pharmacy, which the company has been developing ever since its 2018 acquisition of online pharmacy PillPack for $1 billion, and provides the company the ability to fulfill and deliver medication. Another example is a line of medical devices, which includes a wearable band called Halo that monitors its users' vitals and other health-related indicators. But many of Amazon's initiatives haven't been dedicated products or services. Instead, the company has been updating pre-existing infrastructure to ensure that Amazon's current products can support the delivery of healthcare services, like its voice assistant Alexa, which was recently updated to comply with HIPAA regulations, which is a set of important rules and requirements that any product or service must follow when transmitting or handling any type of patient information. And with all this, Amazon appears to be trying to develop an ecosystem in which all of Amazon's health services integrate with each other to create one unified patient experience. And developing a unified ecosystem like this is crucial because it provides the most important aspect of Amazon's healthcare ambitions, which is a superior customer service. And a superior customer service experience is crucial, not only because it's something the healthcare industry has lacked historically, but because it could lead to the same flywheel effect that led to the creation of Amazon's core e-commerce model nearly 2 decades ago. Because by setting a new gold standard for patient care, whether it be by offering same-day appointments that aren't just a few rushed minutes with doctors drowning in needless paperwork, we're automatically filling and shipping newly prescribed medications to customers' homes directly after their appointments, Amazon is hoping that word of its unique services will spread and lead to an increase in traffic and users to Amazon's healthcare services. This in turn will lead more healthcare providers to become interested in offering their services to this growing patient population through Amazon's healthcare infrastructure, following the theory of aggregation that we spoke about earlier. As a result, Amazon will be able to offer a greater selection of medical products and services to its users, whether it be more types of medications from pharmaceutical companies or better diagnostic tools for its in-person clinics, which will obviously lead to a richer customer experience, thereby allowing the cycle to reinforce itself. And of course, given Amazon's unique investor base that we highlighted earlier, the cash generated from this growth can be invested back into the business, instead of issuing it in the form of dividend, like most conventional companies would have to do with excess cash. This of course would lead to a much lower cost structure, as the company can operate on a much lower profit margin, without the need to generate profits for the foreseeable future, which will allow Amazon to lower prices for the medical products and services it offers to customers, which leads to an even greater customer experience. And on the cycle goes through these two loops. But the total upheaval of the healthcare industry is far from here, and is still very much in its infancy, because much of this is still the hopes and dreams of Amazon's management, and there's no guarantee that Amazon will be successful in its ambition to revolutionize the healthcare industry. After all, Amazon is hardly the first tech company to recognize the value that could be created and captured by expanding into the healthcare market and disrupting such an inefficient industry. But if successful, Amazon would definitely be an outlier, because the healthcare industry is notoriously a giant graveyard filled with failed ambitions of big tech companies and their idealistic vision of tech-enabled healthcare. Take Google, for instance, which in 2005 started a healthcare division called Google Health to create a more efficient way to store and manage patient data. But the project was later called off, and in 2021, Google officially shut down its health division within the company, putting an end to a 16-year effort to create a meaningful presence in the healthcare industry. And a similar story arc was seen at Microsoft, with the company launching its own service to manage patient data called Microsoft Vault in 2007, before ultimately shutting it down in 2019. Even Facebook has tried getting in on the action, launching a service called Preventive Health in 2019 for patients to connect with healthcare providers. But so far, the service has failed to attain any meaningful adoption. Only Apple has managed to achieve some semblance of success, embedding a number of well-being and diagnostic features into products like the iPhone and Apple Watch. But attempts to expand beyond this have been challenging, with the company shutting down a number of projects meant to expand further into healthcare in 2021. But despite Silicon Valley's poor history when it comes to disrupting healthcare, Amazon appears unwilling to heed the warning that all these failed projects represent. However, it does so not out of arrogance, but instead out of a need to please investors and maintain its highly inflated stock price. But whether or not these conditions will act as a sufficient enough forcing function to finally put an end to Silicon Valley's poor track record when it comes to disrupting healthcare remains to be seen. And so with that said, I'm curious to hear what you guys think. Do you think it makes sense for Amazon to enter the healthcare industry? And what do you think about the approach they're taking? Do you think they'll finally put an end to Silicon Valley's abysmal track record with successfully entering healthcare? Let me know in the comments down below.